Good afternoon. The New South Wales Government has handed down its 200th state budget, predicting a $3.6 billion deficit. It's expected to be in the red for the next 4 years.
The New South Wales Government has just released the new budget for the next financial year. Starting in July, visiting a GP will likely be free, electricity subsidies are up, and there will be more schools, more hospitals, and more public housing. These are the highlights of this budget, but that's about it. There's no generous spending spree, and the state's budget is in severe deficit, projected to continue for the next 4 years. Moreover, critical information buried in the budget paper that the media hasn't reported could impact future property investment in Sydney, New South Wales. This budget does not benefit most property investors. New South Wales not only extracts profits from investors, but also imposes additional burdens on overseas investors, signalling a persistent stance against foreign investment in Sydney properties. Hi, I'm Alex. Welcome to Oz Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. The economy of New South Wales is getting worse year by year. Before the pandemic, there was still some fiscal surplus. But after the pandemic, it's been a deficit every year. And this budget is no exception. The New South Wales Government expects a deficit of $3.6 billion for the next financial year. In this year, the growth of the state's gross state product has dropped to 2%, a historical low. What concerns me more is the debt situation of the New South Wales Government. The current debt has reached $155 billion, equivalent to 18% of the state's annual output, higher than any period in the past 30 years. By 2028, the debt level is expected to reach $200 billion. In today's high-interest environment, holding more debt means paying higher interest. Currently, the annual debt interest expense is $6 billion, and by 2028, it will reach $9 billion. With the New South Wales Government running a fiscal deficit every year, have you ever thought about where this money is going? We will next go through the items in the budget that are related to property investment. Unsurprisingly, under the current cost of living pressure in Sydney, the most critical issue is housing. At the other end of the society, 5,800 people are waiting in line for public housing, including low-income individuals and people experiencing homelessness. The New South Wales Government plans to build 30,000 public housing units on government-owned land to alleviate social pressure and provide social security. The main contractor is Landcom, the New South Wales Government Housing Department. The government will also release 44 sites for private developers to build housing. The exact 44 sites are yet to be announced. From a social perspective, building public housing is undoubtedly good, helping to ease social conflicts and improve happiness. But for property investors, it's not. Imagine if a public housing project is built next to your house. What impact would it have on the property's value? There's no need to guess the value of your house will decrease. So when investing in property, consider whether it's near government-owned land. Areas near train stations or TAFE campuses are worth paying more attention to. In the next 5 years, Sydney will enter a major development phase with intense construction of medium to high-density apartments, generally within the 400 meters of transport hubs. If you own a property near a train station, you may have already received a rezoning notice from the government. If so, celebrate, because your property's value will surely increase. For those who haven't bought a property yet, where will the major development over the next 5 years take place? Mainly in the southwestern and northwestern parts of Sydney. The Hills Shire Council plans to build 23,300 homes, Parramatta 19,500, Blacktown 21,400, and Liverpool 16,700 over the next 5 years. Most of the budget's infrastructure funds will be spent in these areas. Then, the key infrastructure projects. Parramatta Light Rail Stage 2. The government has allocated funds for the second stage of this project, which has been delayed for at least 7 to 8 years. Finally, it is starting. Residents along the route can celebrate a bit. The yellow line in the diagram represents Stage 2 from Parramatta Square through Camellia, Redomare, Melrose Park, Whitworth Point to Sydney Olympic Park. Most properties along this route are apartments, including undeveloped areas. Apartment developers and agents are likely to be excited again. Will property prices along the route increase? I think so, but not as explosively as when the light rail plan was first announced. Still, it's a very convenient travel option for local residents. The Western Sydney Airport is under construction and expected to be operational by 2026, less than 2 years away. The surrounding airport city known as Atropolis also needs to be built quickly. The budget allocates another $62 million to help construct a new airport city and launch a rapid bus service connecting the new airport with nearby suburbs. There's also a hidden bonus. The highway from M2, M7 to the airport city and the new airport will be toll-free. Box Hill will get a new public primary and secondary school, easing the pressure on nearby schools. Bankstown will get a new hospital, creating numerous job opportunities. Rouse Hill's new hospital will receive $700 million in construction funds. This hospital has been a selling point for Rouse Hill Apartments since before the pandemic, and now with the funding finally in place, it's worth celebrating. Many people who don't understand the underlying logic of economics and property investment have different interpretations of terms like major development, building a lot of properties, and property prices rising. For example, major development can mean future growth and a substantial increase in property prices, or it can mean no one lives there now, so it's not worth buying, or that many houses will be built, so property prices won't rise. Building a lot of houses can be understood as an oversupply of properties, so prices won't rise, or that there is a demand that justifies building houses, and even so, the supply might still be insufficient, leading to a significant price increase. Property prices rising can be seen as a sign that the market is on an upward trend, prompting continued purchases, or as an indication that the prices have already risen and it's too late to buy at the lowest point, or that prices won't rise further, making it the wrong time to buy. See, these logics all make sense, but they are just a logic. Just because something is logical doesn't necessarily mean it's true or will happen. Making predictions requires a deep understanding of economic fundamentals and property investment, which most home buyers lack. This is precisely why this channel exists. The population growth in Sydney may fluctuate, but the trend won't change. The government will approve more high-rise buildings, but no one knows if there will be enough people to build these houses on time. In the short term, I don't foresee a situation where housing supply exceeds demand. The market will experience some fluctuations, but the speed of building more houses will be slower than the population growth, and this trend won't change. On the other hand, the tax policies introduced in this budget will indeed dampen investor confidence in the short term, negatively impacting the market. For the 2024 land tax year, the land tax threshold is set at $1,075,000. This threshold will remain unchanged next year and will not be adjusted for inflation in the future. It's expected to bring in $1.5 billion in revenue for the New South Wales government over the next 4 years. In New South Wales, owner-occupied homes are exempt from land tax. Only when the combined land value of investment properties in New South Wales under the same owner's name exceeds the land tax threshold is the land tax payable. The amount is calculated as the over the threshold part multiplied by 1.6% plus $100. For example, if the land value of your investment property totals $1.2 million, you subtract $1,075,000, multiply the remainder by 1.6% and add $100, resulting in an annual payment of $2,100. Assuming this 1.6% tax rate and threshold remain constant, will you pay more or less over time? Well, definitely more. Land values typically rise annually, and it's not up to you to decide their value. The government appraises the land and tells you what it's worth, then taxes you accordingly. As land prices increase, those who previously paid little tax will pay more, and those who paid none will now have to. Hence, it's like boiling a frog in warm water, slowly extracting money from property investors in New South Wales. Property investors should renew their portfolio annually. Do the maths and stay informed. Since 2017, New South Wales has taken a 180-degree U-turn regarding overseas buyers, from welcoming investment without restrictions to welcoming it but charging fees, and now to not welcoming it while imposing high additional fees. Overseas investors must pay an additional 8% stamp duty surcharge. From the new financial year, this additional stamp duty will increase from 8% to 9%. This means that overseas buyers will need to pay a 4% stamp duty plus a 9% stamp duty surcharge, totaling 13% when buying a property in Sydney. Overseas buyers also face a 4% land tax surcharge. On top of the local land tax payment, they must pay an extra 4% of the land value annually to the New South Wales government. This fee has already deterred many overseas investors. However, starting in the new financial year, the New South Wales government is increasing this surcharge to 5%. It appears that targeting overseas investors is a long-term strategy with no signs of easing. New South Wales has become the harshest in Australia in punishing overseas investors, making other states and territories seem generous.
4.35% remains Australia's cash rate following today's announcement from Michelle Bullock, unchanged now since November last year. The risks, we're told, remain throughout the economy, so those with a mortgage will have to wait for relief.
Inflation is still above central bank targets in many economies, and it is proving to be sticky. And the progress in getting inflation down has slowed, and Australia isn't any different here. 3 of the big 4 bank economists see 5 rate cuts by the end of next year. But the Governor of the Central Bank declined to give any weight to those kinds of predictions today. We still think we're on the narrow path. It does appear to be getting a bit narrower. We need a lot to go our way if we're going to bring in the 2% target range.
In this week's Reserve Bank of Australia interest rate decision meeting, they decided to keep the interest rate unchanged at 4.35%. This aligns with our prediction from the monthly live stream 2 weeks ago. However, the recent rebound in inflation in Australia is quite evident, and the federal budget's money spending approach will add inflationary pressure. Additionally, the unemployment rate hasn't risen significantly. Therefore, I believe RBA is not keen on cutting interest rates soon. That said, many G7 countries have already started their rate-cutting cycles, and Australia will likely follow suit, although the timing is uncertain. To summarize, this New South Wales budget does not directly distribute money to the public, but focuses on infrastructure and housing construction, addressing the root causes of housing shortages and high rental prices in New South Wales. This is definitely good for the public. For property investors, however, especially overseas investors, there are more unfavorable factors. From the perspective of supply and demand, the ultimate determinant of property prices, I believe there will be no fundamental shifts in this relationship for at least the next 2 years, and it's unlikely in the foreseeable future. Although the property investors' nominal profits might slightly decrease due to this budget, it does not fundamentally affect the underlying logic of making money by investing in property in New South Wales in the long run. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. Have a good one. Bye.